between 16 and 29, you're eligible for $200 a week, so 10 grand a year effectively is funded of their wage. And for 30 to 35-year-olds, it's half that, so $100 a week, 5 grand. That could be the difference between a hiring decision on if you're on the fence about do we need an extra headcount or not.
Well, welcome to the Business Owners Forum. Great to see everybody again today. And we've actually got another great speaker for today. So we've held these for the last 21 weeks or 21 sessions, I should say, and they've been really, really well received. So we've obviously covered lots of great topics in that period of time, and they're designed really to support business owners and give them information and knowledge around how they can continually navigate through the complexity of business and, really come out of what we're dealing with at the moment in a thriving way. And obviously it's been pretty challenging over the last 9 months with regards to COVID, and we've experienced lots of difficulty. Now, we're all at different parts of the economy and different, depending on what state of Australia you're in, but we're all experiencing something relating to COVID. So, that's always a bit of a theme that we've run for the last 21 sessions. And this week, is going to be a session around the federal budget, which obviously has a fairly strong lens on it with regards to COVID and the stimulus for business, and really that's been the theme around the government, federal government budget that we've actually got. So actually today we're going to hear from Matt Smith. Matt Smith's one of the partners at Prime Accounting Business Advisory, and he's presented a number of times in these particular forums, and we always welcome his insight into the knowledge around, especially around tax, and we're going to cover off on a fair bit of that today. So we're going to hear from Matt to talk about really the federal government and the changes and what they mean for you and for your business. And we'll also talk about, from an overarching perspective, how, hopefully what we have in store for the next 12 months in regards to this and what we can hope to achieve from these particular changes we've got coming through. So I'm going to welcome Matt today to our session. So welcome, Matt.
Thanks, Matt. Hi, everybody.
So, Matt, obviously the federal government announced its budget last week, and we put out a pretty extensive note to all of our clients in a written format in terms of, what the changes were, the proposed changes are. Since then, most of those have actually gone through legislation. So therefore, we're now dealing with law, which is good because it's always good to deal with the detail behind it, because a lot of the time it's hard for us to understand exactly what the changes are going to be when it's only an announcement, not necessarily law. So good to see that we've got a little bit more detail around that. So it'd be good for you to really talk us through how some of these changes are going to impact upon, our business owners and business and the individuals that we actually have. So, but probably from an overarching perspective, I'd like to get your thoughts on what you thought about the budget from an economic stimulation perspective, from a country point of view, from how it impacts upon business. I'd love your thoughts on those things.
Yeah, okay. So look, I think at the end of the day, there's been commentary from many pockets in terms of, what the budget results will end up being. And I think some people have been criticising, saying that this budget's purely pegged at business, saying that that's going to be the sole driver of an economic recovery. And so whilst I'm not a pure economist, and that's probably not my forte or not my position to say, being, I guess, an advisor to small businesses day in, day out, it was kind of music to my ears that was where a lot of the stimulus was pegged, because it's certainly going to help our clients and I guess us in terms of helping our clients to sort of drive their businesses and to ensure that they're not only surviving, they're sort of able to really thrive and be a part of that, I guess, economic turnaround that hopefully some of these things are driving.
Yeah, and that's exactly right. I think the government have sort of looked at it and thought, well, how are we going to, stimulate the economy? And obviously business is the best way to do that, because it's all about getting people into jobs. It's one of the major things that governments are required to do is to create an environment that does support, economic stimulus. And so the best way to do that is to support businesses, because they're the ones that are going to employ people largely to be able to, get them into paid work, and getting them into paid work stimulates the economy because it increases the GDP of the country. So from that point of view, I think it's obviously a tactic and a strategy from the government perspective to ensure that, hey, what's the best way to really sort of stimulate and really kickstart the economy again now that we've been through this period of economic uncertainty because of what we've dealt with in COVID. So, look, we're not here to sort of, editorialize or, be overly economic opinionated around whether it's good, bad or otherwise. But, I think that what it does do largely is assist businesses to be able to go and do what they need to do, which is grow, develop and employ people, which I think is great for everybody.
And I guess one thing we have seen in Queensland, being a little bit ahead of you guys in terms of the fact that we're sort of a couple of months post-lockdown now, is that, pretty quickly the businesses, apart from, the really highly affected industries like tourism and I guess entertainment and those sorts of things. But a lot of businesses, getting very close to being back to normal. So I guess that's a really positive for our clients in Melbourne who are probably not quite at that stage yet, to know that, demand is still out there. People are, looking to spend their money. They probably haven't had anything to spend their money on over the last little period. So, hopefully that Victoria can follow suit in that respect as well. And we're certainly seeing with our clients in Queensland that some of the doomsday planning that we had done certainly didn't come to fruition, and that business is returning, inverted commas, to getting close to a normal state. So
that's really good insight, Matt, and it's encouraging, especially, obviously highlighting that I'm in Melbourne and in Victoria. We have offices in Sydney, and we obviously have offices in Brisbane where you're located. And it's fascinating from my point of view just to see how, in terms of just being in one country, how there's such a different vibe and feeling depending on the state that you actually currently reside. And, I'm very buoyed by the fact that, we've got our Brisbane office, and I get to speak to you, pretty much every week, every day around, how you guys are feeling about, what's been going on from COVID's perspective because, we run businesses and we advise businesses. So, this is something that we're a student of every day. And it gives me some comfort to know that you guys have bounced back pretty quickly, and to the point where, we often joke or laugh about it, about the fact that you guys don't really feel the effects of COVID that much anymore, whereas, we live and breathe it every day, given that, we've still got fairly strict lockdown measures, but hoping that that's going to ease up. But the biggest takeaway from that, for me, with what you just said then, is very much around, that it can bounce pretty quickly once you get out of lockdown and you're able to kickstart and stimulate the economy, which is the same thing that I think the government recognise that and say, well, that being the case, let's put it in the hands, let's give businesses the opportunities and the tools to be able to go and really do what they do best, which is stimulate the economy. Totally. So that's really awesome. I really appreciate that. And I think that people that are hearing this in Melbourne hopefully are feeling also confident that that's going to be the case, given that's been Queensland's experience. So we're hoping to follow suit in that regard. Just turning our attention back to the budget and, some of the measures and the changes that have actually occurred. Obviously, business and tax has been a fairly strong point about that. And what I'd really like to cover off on is really taking us through some of the tax changes, okay, and the reason why governments will use tax is because it's a way of getting, stimulating and putting money back into businesses for them to then go and spend money. And that's the whole point to it. They want businesses to be able to go back and spend, because that will then generate the GDP of the economy. It creates a stimulus, it creates jobs, okay? And that's fundamentally what we want to see happen for all of our livelihoods. So love for you to take us through the major keys of the changes and also, how they specifically impact upon business and what we can access and what we can to be able to do these things, to be able to then go and stimulate our businesses and then the economy.
Can do. So, look, the first update is in respect of the instant asset write-off and the fact that that's probably been extended. So we saw several iterations of this throughout COVID in terms of an initial, instant asset write-off to June, which was then subsequently extended to December of 20. That's now been extended right out to June 22. And so, it's effectively a situation where any business up to a turnover of $5 billion. So that's going to be the majority of businesses that we're certainly dealing with in the small business space, and a lot of big businesses, really. If you think about
when you get into the billions, it's a big number. So I wouldn't say that's a small business measure. I'd say that's kind of largely covering a lot of business in Australia.
No, and that's exactly exactly right. So any asset purchased after budget night, the 6th of October, we're going to get an instant asset write-off for that. And I guess again, for a lot of small businesses, we had up to $150,000 anyway, and a lot of those assets that we're thinking about buying probably fall into that category, and at worst, if they didn't, that we were able to pool them and then sort of get it sort of an accelerated depreciation from that perspective. But what they've kind of said now is that also any pool balances can be completely written off up to that time as well. So what it means is that clearly some of these bigger purchases, which are going to, business to business and are going to start driving spending patterns and getting money flowing in the economy, they're trying to encourage those, and so I guess that's definitely going to help it, and particularly I think with the lens of trying to give businesses as much help as they can in terms of not having to worry about tax on profits for the next little while, and maximising their deductions by bringing them forward that they otherwise may have had to wait a couple of years to get.
It's well worthwhile highlighting, the actual effect of this, because, instant asset write-off and deductions and that sort of stuff all sound, good, but what does it actually mean? And what it really means is that when you go and buy an asset, typically you would have had to depreciate over its life. So you only get a certain amount of deductibility on that each year, because what happens then is that means it's releasing a certain amount of expenses every year, which will have an effect on the profit. And basically you pay tax on your profit fundamentally in business. It's a taxable income thing. So if you're able to spend $150,000 on an asset, and you're able to get a tax deduction for $150,000, it's going to reduce your profit, therefore reducing your tax, therefore means that you've got more money in your business to be able to go and invest into other things. That's kind of the basis behind it. Would that be fair to say, Matt?
Completely. And I guess a couple of the questions that I've had come across my desk from my clients have been, one, can it still be financed? So what happens if I finance the asset and pay it off over what would be normally the life of the asset? That's fine, as long as it's in the right, normally it's a chattel mortgage or something like that. As long as it's got the right type of finance, then we can absolutely still claim a deduction for that. And then I guess the other question that has come across my desk is people asking about motor vehicles. So these deductions are still subject to the luxury car tax limit. So don't go out and buy yourself a $100,000 motor vehicle thinking that you're going to get a $100,000 tax deduction. It's still subject to that limit of about $57,000.
Yeah, I was going to say it's one that's always the burning question that I get a lot of the time is so I can go buy a car and say, yes, you can, and you can get the accelerated depreciation associated with it, but it's obviously subject to the luxury car limit, and it's also subject to potentially fringe benefits tax and and private usage as well. So we just have to be mindful of some of those sorts of things. So that's probably specific advice for people that if they are thinking about buying an asset that's got mixed use, meaning that it's got private and business associated with it, to actually work through the calculation as to whether this is going to be beneficial or not. But for anything that's a solely business asset that is classified as a depreciable asset, then that would apply. The other one is that I get is means that can you depreciate certain items in, like when you've got rental properties. Now typically rental properties have got a different sort of type of depreciation schedule, so capital allowance, and that's depreciated at 2.5% typically every year. Those sorts of categories of assets aren't the ones that you would be able to accelerate to 100%. Is that fair to say from your point of view, mate?
Yeah, and I think the key point to that is the word business.
Yeah.
So, generally we think of a rental property or something like that as it's a passive asset. It's not necessarily a business. So that's, I guess, just having a chat to your advisor and understanding the difference between, having a passive asset where we may still have depreciable assets versus running a business, because it's for businesses that this instant asset write-off applies.
Yeah. So look, I think as a piece of law and for its intent in terms of stimulating the economy, I think it's a good piece of law. It's a good proposal from the government, and it actually puts the opportunity in the hands of businesses to go and spend money because they'll get a significant tax benefit and reduce the ultimate tax that they're paying. So I think it's a good piece of law.
Yeah, and particularly if you're on the fence about a strategy, you might need a new piece of equipment that then, when you think about in terms of your business strategy and profitability, it may open up other revenue streams. It may open up other ways of, pivoting in your business, which I guess is all what we're focusing on at the moment, is to, look at your business from a wholesale perspective and see whether there are new ways in which we can make money.
Exactly right. So it comes back to the strategy of the organisation. So I think it's a fair point to make. So what other sort of measures that they announced last week that's going to help us from a business perspective?
So another big one is the loss carryback rules. So people who have been in business for an extended period of time may remember that we've had these rules sort of at various times over the last sort of 15 or 20 years, and maybe even before that, but that's about as far back as my knowledge goes.
I might go back a bit further than you.
But so the carryback rules have been introduced, and what it's basically saying is if you incur a loss from the FY20 year or beyond, that for any tax that you've paid from 19 and beyond, you can actually effectively get that refunded back to you. Mm-hmm. So I'll give you an example of, we've made $100,000 profit in FY19. We've paid $27,500 worth of tax on that. Mm-hmm. Then in the 2020 year, because of COVID and various other bits and pieces that have happened, we've actually incurred a taxable loss of $50,000. We would get half of our $27,500 back as a refund, as cash in hand. So normally that $50,000 would be carried forward until future years to be used to offset against future profits. We can actually now access some of that tax that we've already paid and get that back as a result of the loss.
Which is pretty amazing, and it is great because, there's a lot of people that say often, look, I made a profit that year and I paid tax and I'm not making a profit this year. And so there's an inequity that goes on, when we're trying to smooth it out over a 2-year period of time. So once again, I think it's a good piece of law, and it's kind of the way that the research and development tax rebate works in a similar sort of fashion, which I think you're going to cover off on the later on in the session as well. But once again, being able to cash out, like what we call cash out your losses, so to speak, once again, is putting money in your pocket that you can then go and spend, which I think is also fabulous as well.
Absolutely. So look, that's probably not a bad segue, Matt, to touching base on the R&D side of things. Mm-hmm. We were obviously do quite a lot of R&D in our firm, and we work with a lot of high growth, high IP businesses who are spending a lot of money on R&D.
But maybe just talk a little bit about what R&D actually is before we get into the changes in terms of its expenditure relating to research and development. Yes. That you're able to get a tax benefit from. So if you want to just quickly explain that, and then we'll talk about what the proposed changes were going to be, but ended up not being, which is good.
Yeah, sure. So look, it can get quite technical, and we won't get right down into the nitty-gritty of it today, but effectively, if you are spending money on new and novel either goods or services within your developing those within your business, then you may be able to access what's called the R&D tax offset. And so new and novel, I think the easiest way for me to explain it is if you think of a scientific hypothesis, you're not actually sure of an outcome that you may reach, but you think if you can crack the nut on it, that the new product or service is never been seen before, and that would be a competitive advantage for your business, then that's I guess how you would access this.
And it could be across different things. It could be across software that's never been developed before. It could be across, biotech, where you're developing drugs and compounds. Obviously, the COVID vaccine would be one of those. It could be, machinery that's never been developed before, or a medical device. So it can be anything that relates to, I suppose, something novel, as you say, that's never been developed before, and you're prepared to spend money on it to develop something that could become a commercial asset that's going to drive, growth not only for your business, but obviously some benefit for other businesses or for individuals and for the economy.
Spot on. So please talk to us about the actual specifics of what an application looks like and those sorts of things. If you haven't done it before, but you think you might be doing R&D, because it's definitely worth having an initial conversation just to investigate that first before going down the track too far.
Sure. So I suppose now that we understand the R&D and you're able to get, like we said before, to really get some of the money back that you spent in R&D, and that's done through a mechanism if you're under $20 million in turnover through rebates, a tax rebate, if you're in a loss scenario. And I suppose over the many years, this R&D tax incentive program has been in place for over 30 years. They have changed some of the law over that particular period of time and made it more attractive for people to sort of spend more money on R&D, that sort of type thing. They were considering changing that again, but it looks like they haven't done that in the latest budget. So do you want to just talk about that, Matt?
Yeah, so effectively the way it works is currently for every dollar that you spend, you get 43.5% back on eligible R&D spend. So if you've spent $100,000 on eligible R&D, you would get a cash in hand. If you're in losses, that's all you're doing. You've spent $100,000 on R&D. The whole spend was R&D. You would get $43,500 back cash in hand. Where that was about to potentially change, so that side of it is not changing in terms of the 43.5 on eligible spend, but where it was about to change is that the company tax rate is proposed to drop from 27.5% to 25%.
Right.
From next year, and aligned to that, the R&D rate was therefore going to drop to 41 to keep the differential of 16.5 cents. So what they've decided to do is to maintain the R&D rate of 43.5 cents, so that once that 25% company tax rate kicks in, the differential is actually going to be 18.5 cents benefit in the dollar. So what we're talking about here is businesses that are actually profitable, where they're not in losses, and therefore that they're not accessing the full 43.5 cents in the dollar back. They may have normal taxable income of $100,000, but they've got eligible spend of $50,000. So what they're going to get is a benefit of 18.5 cents in the dollar on that R&D spend.
Makes sense. And we have done a forum on R&D in the past, so we can also share that too in our previous sessions that goes into sort of more of this detail from a sort of a case study and slide perspective. But what I'm always pleased to see is that they don't tinker too much with the R&D tax incentive program, because it actually is a great program that is world class, and people do spend money in R&D because of the fact that they're able to access this particular program, and we do over 300 of these R&D tax returns every year, and we see the real benefit and the investment that goes back into R&D because of this, which makes us, world class in terms of how we actually go about, developing products and services in the marketplace. So I was really pleased to see that they weren't reducing, but they were actually, stimulating continuing to stimulate the economy through sort of R&D. So I think that's fabulous.
Agreed. Okay, so look, probably the other major one that came out, which is a new policy in terms of the budget, was the JobMaker credit.
Yep.
So look, just at a high level in terms of what this credit is, effectively from budget night, so from the 7th of October, the day after budget night, it is if you hire a new staff member in the next 12 months, you could be eligible for a credit towards hiring that new staff member.
Okay.
So, like any of these things, the devil's in the detail with that, so maybe we just go through a few of those items just to explain where you would be eligible for a credit. So the first bit is that you can no longer be on JobKeeper. So for a lot of our businesses, probably I would say only 20 to 25% of the businesses that we had on the original JobKeeper 1.0 from April to the end of September have continued to be eligible for JobKeeper 2.0 at this point for the next quarter.
I think that's probably state-based, because I believe that going back to our earlier point today about the economy, that I'd say that there'd be more accessing that in Victoria, the JobKeeper 2.0 compared to what's happening in Brisbane because of the different sort of stages we're at with lockdown. So, and can I just make a comment about JobKeeper, in that it's one of the best things I've ever seen in terms of an economic stimulus that's actually been put out, where you actually see the impact it has. So we do a lot of work with our clients and do monthly financial reporting, Matt, and you know that what you're seeing is that every month you see a profit and loss, and the bottom line, it's either going to be a loss, a break even, or a profit. And so many times I've seen that JobKeeper has been the difference between a loss and break even, or a loss and a slight profit, which just shows you the impact that this has had in terms of keeping businesses alive during this economic downturn. And I've been delighted to see how this has actually benefited and kept businesses alive during this period of time. So I really said it was a good piece of law. It was a good initiative by the government, and I can see it on a micro level, on a day-to-day level, from a business perspective, the impact it actually has had on businesses. So I think that, JobKeeper 1 and 2 have been great. The criticism that we can hear in the budget and the marketplace from editorial is that, to keep that going, because it actually has been such a great sort of thing. But interesting what you just said, it's gone from being taken up widely under, version 1, less so in version 2. And maybe that's what Victoria's going to experience as well, that maybe the need for it might drop away significantly as hopefully the Victorian economy starts to get back on its feet again. So,
and I think if I look at that,
well worth highlighting it, because I really have seen it, as I said, really strongly, macroeconomic policy, really down to that sort of micro level of day-to-day businesses and looking at profit and losses every month.
Yeah, completely agree. And I think if I look at it in terms of the flow here, in terms of how that went, I definitely think April, May, June, you're right. It was definitely, keeping the boat afloat. But through July, August, September, as we started to open up, we were trying to encourage clients to make sure that they were profitable without it, so that if and when they came off it, there wasn't going to be a big hole there. And as time wore on, we definitely started to see that. So I wouldn't be surprised if you start to see, as things are opening up, that all of a sudden it's now the buffer zone as opposed to the thing keeping business alive. So
right.
Yeah.
And so the JobMaker, as you say, is kind of an extension, because you've got JobSeeker, JobKeeper, and now JobMaker. JobMaker is kind of the extension to that, to getting people like from retained in organisations through Keeper into being employed into organisation in terms of, reducing unemployment?
That's right. So effectively, as we just said, you can no longer be on JobKeeper. So you need to have progressed out of that to be eligible to apply for JobMaker. You don't need to have applied for JobMaker in advance of employing someone. If you've employed someone after the 7th of October, we can work backwards to that. So don't let it hold up any of your hiring decisions. But effectively, it's for young Australians. So 16 to 35-year-olds is the category that it applies for hiring. So probably the one criticism, if you like, that I'm hearing, and I sort of tend to agree with, is the fact that it's only for employees who have been on some form of Centrelink for the past 3 months.
Right.
And so that, I'm thinking practically in terms of how a hiring decision's made, it's potentially a bit difficult in terms of sort of understanding to an eligible candidate, have you been on one of job seeker, parental leave, so a mat leave scenario or a pat leave, or probably the one where I think it might apply is where you've been on youth allowance, which is effectively our uni students coming out of uni and potentially being eligible for their first grad jobs and those sorts of things. So,
and the fact it's under 35 too. So there's obviously terms and conditions that, as you say, the devil's in the detail. And, this is where, there's unintended consequences sometimes in the law, and there could be some unintended consequences for this particular policy. It doesn't seem to be as probably all-encompassing to achieve what it wants to achieve, is probably what I'm hearing as part of the editorial comment that you made, and also that other people are making in the marketplace.
But at the end of the day, what I do think is, so for between 16 and 29, you're eligible for $200 a week, so 10 grand a year effectively is funded of their wage. And for 30 to 35-year-olds, it's half that, so $100 a week, 5 grand. That could be the difference between a hiring decision on if you're on the fence about, do we need an extra headcount or not. So I think from that perspective, that's a good thing. And the only other caveat is that it does actually need to increase headcount. So it can't be a replacement role. You need to have net headcount increases to be eligible for it.
Understand. So there's a lot of detail in that one that you have to be mindful of. So really work through that before you make any strong decisions about whether you would proceed on that basis or not. And hopefully, it's a benefit. As you say, really, it's designed to help you make a decision to employ somebody and reduce the barrier to do so.
And it's not an immediate an urgent decision to make. It's any new employee in the next 12 months, and it's paid for a further 12 months on top of that. So we've sort of got a 2-year window where this is going to be relevant. So hopefully as businesses are coming out and improving and growing, that hopefully there's more and more decisions about, do we grow headcount and more jobs available. So.
So one of the other things that there's always in the budget for is how it relates to individuals, and business owners are individuals too. So therefore we end up having to have an impact, and we want to see what that means. So I think there's been some tax relief for the individuals that you wanted to cover off on today as well.
Absolutely. So the tax relief for the individuals had already been mooted. So this was a plan as part of the last federal election that there was going to be some tax relief coming over the next few years. And part of that has just been effectively brought forward. So effective from the 1st of July 20. So we've actually sort of had 3 months of it already without even knowing it. But now that it's legislation, what's going to happen is that the 19-cent tax bracket is jumping from 37,000 to 45,000. So, for every dollar up to 45,000, we're only paying 19 cents in the dollar tax.
Post 20,000.
Sorry.
So you've got the tax-free threshold as well, though, obviously up to the 20.
Sorry. Yes. And then the 32.5% tax bracket, which is the next bracket, is jumping from 90 to 120. So, I think that's relevant for everyone, as you say, particularly on a personal level, but also, when we've got the business owner lens and we're talking about, remuneration to business owners and trying to get the balance right between, not paying excessive top-up tax in terms of what we're actually paying our business owners. This is going to be welcome relief in terms of the fact that we can, get to 120,000 now, which is an extra 30,000 per owner or per associated individual, without, even if we're doing a dividend strategy, without having to pay an excessive amount of top-up tax.
Yeah, and so it helps for planning, but ultimately what it's designed to do is put more money in your pocket. So less, when you're paying gross salary, less in the government pocket, more in your own pocket. So therefore, you can spend more money, which is about stimulating the economy once again from an individual's perspective, not just a business point of view. And really what you're talking about is the fact that they're bringing forward some of these tax relief measures that were going to be in future years. They're bringing them forward to really, as you say, 1st of July 2020. And there's more to come too, I think, Matt, in terms of changing some of those scales. So it's more about the brackets rather than the actual rates themselves.
That's right. The long-term plan is to actually have a flat rate of 30% tax, which is capped at a lot higher rate than the current top marginal tax rate. So that's the long-term plan.
Which is great. And obviously, what that does is it helps to stimulate the economy in immediacy. But what it also does is it makes us attractive for people to want to come and live here. It makes us attractive for people who want to stay here and develop technology and keep our sort of, intelligence in the country rather than moving off into international waters because of the fact that it might be a more beneficial place to be from a tax perspective. So it's got some immediate benefit, but hopefully some long-term benefit too.
Very much so.
Yeah, so it's good. Is there any other anything else that you wanted to cover off on today, Matt, in terms of the federal budget and the announcements, or any tax measures, or any other points, or any other questions that you're getting from business owners at the moment that are coming across your desk?
Look, I think they're the high level big ticket items. So yeah, we're still having constant conversations and busy at the moment reviewing eligibility for JobKeeper 2.0, and we sort of had a little bit of a chat about that already. But I think very much it's just getting back to business as usual as much as possible, and starting to have conversations about what's the next, do we need to realign our strategy, what's the next sort of 12-month window look like now, to make sure that we're planning appropriately and accessing some of this stimulus where we can.
Yeah, exactly. And that's always the message that we speak about a lot, and it's been a theme for these forums is, this is the best time to do business strategy when you're in the situation that we're in, so we can come out from a thriving perspective rather than not. So, or, at least surviving through what we need to survive through so we can come out the other end. So strategy is really, really important, and accessing sort of whether they're government grants that are available at the moment or tax stimulus that's available at the moment, making sure that we get as much money in our hands as we possibly can to keep that, like I call it, the runway of cash, so we can our businesses can take off, and that's really important to keep building that. So the more work we can do in that strategic area, the better. So I agree with that, Matt. So look, it's been once again a great chat today, Matt, and I really appreciate your time. It's very valuable, and your insights are fantastic, and always enjoy having a chat to you, Matt, about those particular things. Obviously, either live like this or we do it, just on a weekly basis as we talk about lots of things. So look, I always feel like, any sort of information that we get from this is good information. As I said, we wrote a note last week around this whole thing, but I think it's good to put some sort of, live element and some real element associated with it too. So, which is what you've done today. So very much appreciate your time, and it's been good information. So we'll look forward to seeing you next time.